Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
All right, welcome back to the Gentle Art of Crushing It podcast. My name is Randy Smith, and I'll be your host today, and really excited to have Joe Rinderknecht with us. Joe is the principal and co-founder of both Upgrade Partners Capital and Cowboy Capital, and really excited to jump in and talk about his business, which focuses on really the sub-100 multifamily space, and he's in the Western United States. So think Idaho, Utah, and Montana. So Joe, welcome to the show.
Thank you, Randy. Excited to be here and add some value to your listeners and have a great conversation today.
Outstanding. Well, hey, let's jump in how we always do, and I'm going to ask a kind of broad general question, but I'm curious about your thoughts about the current state of the market and how that might be impacting the passive investors.
Yeah. Well, I think it's very interesting where we find ourselves today, right? With the interest rates still fluctuating up and down. You know, my partner and I've been watching like the 10-year Treasury and how it's like, this last week it dropped like 30 basis points and then it went up, and we're like, oh, we can get more competitive on financing. But then it like started going back up again. We're like, you know what, let's just, for us, let's just let the rate stay up. We can get better deals. Right. I think though, like as far as LPs go, it's a tough market. I'll tell you an experience I had. So I was under contract to buy an 80-unit apartment complex in Idaho. And I was under contract on that deal for 5 months, right? From October to, right. And we only needed to raise about $3.25 million in common equity. And this deal, like we were getting seller financing and it was cash flow positive, property level day one. And I don't think it was necessarily my fault. Maybe if I, maybe 5 years down, further down the road, I'd be able to get it easily. But like common equity is challenging right now. And as I really looked at the market, there's kind of two things that we're seeing is like one, the competitive equity or the competitive where the investors are going that we're competing against is the better way to say that is the pref equity or the, debt capital, their double digit returns, 2 to 3 year holds. Right. And it was really comical because like the seller, he was like seller financing with us. Right. And I'm like, hey, you know what? Mr. Seller, why don't you roll an extra like $1 million back into the deal, right? And you can run this long term with us. He's like, your returns aren't good enough. And so it was really interesting on my side because I'm like,
sure,
you're telling me this is the best deals that you've ever seen that for us to buy, but then when we ask you to reinvest, you're like, it's not good enough because he wants to go put his money into a hotel development where he's getting 15%, right? And so, he's like, well, I can't get this money raised. I'm like, for the exact same reason you told me no, is because there's so much of that out there, like the, what do they call it? The rescue capital. We're seeing a lot of that in Texas right now. Even in Phoenix, I mean, there's a sponsor we both know that just launched a pref equity fund to save like 8 deals, right? To buy a new interest rate cap. So we're for us, like common equity, we're competing against the high rate short term. But then also one of my partners on the UPC side, Upgrade Partners Capital, he's a high income W-2 sales guy. And he's like, think about it from my perspective, Joe. He's like, I put money into a deal 3 years ago or 2021. And he's like, my money is tied up there. He's like, we haven't had a distribution in 2 years. We just got a capital call and we have no idea when we're getting our money back.
Yeah.
Right.
Yeah.
And so I think LPs, there's still money out there to be deployed. It's like they got to be the right deals. They got to be cash flowing from day one. But I think LPs have a couple things going against them. The high, as far as common equity, high rate, short term deals. You've got deals where investors are a little gun shy to invest in more long term common equity deals because they're still stuck in some and they've kind of got a bad taste. And then third is, I might have to come back to third. Lost my with the stock market fluctuation and the Dow tanking last week. I have a couple of investors who had told me, Joe, I'm not going to invest here because I'm making 25% in my Charles Schwab account. And so there it's, that's more, it's less risk. There's definitely more volatility as markets fluctuate. And so it's really going to be interesting even going into this next couple of weeks with the Dow and to kind of see what happens, right?
Yeah. Yeah.
I think, go ahead. Sorry.
Yeah, no, it's an interesting time. Like you literally you hit on about 8 different points that I want to come back to and dig into, because these are all the same topics that are going through my mind and my investors' minds, with all the different dynamics that are going on.
Are you interested in real estate investing but don't know where to get started, or think you don't have the time or money? Are you stuck in your W-2 because the golden handcuffs make it hard to walk away? If this sounds like you, check out impactequity.net and schedule some time to talk with the founder, Randy Smith. Randy went from massive income to leaving his W-2 through passive income, and he can help you do the same. www.impactequity.net.
Let's do this. I want to come back to those, but I want the audience to see in you real quickly what I saw when you and I connected a couple of months ago. So Joe, can you kind of walk the audience through your background and your path to where you are today, just to kind of share that origin story and give them some backdrop, and then we'll jump back into this, because this is the stuff I want to talk about, but I want them to know who they're hearing from before we do that.
Yeah, I'll give you a quick one too on the backstory. So for those of you who cannot see me, I wear a cowboy hat. My background is in ranching. I mean, any of you who know German, Rinderknecht actually means keeper of the herd. So the beginning of time, right? We've been cattle ranchers, and my grandpa and uncles, still work the ranch today. So it's very much of who I am and where I came from, and where I really learned a lot of my values, right? Hard work, integrity, your word is your bond, right? When you commit to doing something, like, you keep to your word and you do it. So I started, in that world of ranching. And then when we moved from Utah to Idaho, my dad was a general contractor. So I grew up doing a lot of construction and trim work, got kind of the entrepreneurial bug, from, raising my own small herd of cows and doing, my dad and I built this like perfected picnic table that, you ever been on a picnic table where like 2-3 people sit on one side and then the other person on the other side of the table stands up and the table flips over on it, right?
Yeah.
So like
It's like a seesaw.
We built a table where you could have 3 large people sit and nobody on the other side, and it wouldn't flip over. So we built tons of those for our local campgrounds. Anyway, so lots of experience in ranching, construction. And then as I was graduating high school and time and really thinking about college plans, that was my parents got hit pretty hard in the '08 downturn. And my parents didn't talk a lot about it. So I didn't really understand what even happened in '08, '09 till like I started getting into this business, just because my parents never talked about it. I had no idea that my dad had lost, a couple different houses that he was building. My dad he wasn't home a ton. He was always working. And so it was just it was normal, right? Even as a senior in high school, I didn't see it. Anyways, but it made sense because as I started going to college, my parents were like, hey, we think you actually ought to go be an x-ray tech, because it's a safe, secure job. You can rodeo while you're an x-ray tech and you can make a really good wage, and, the medical world will always be in demand. So I started, I went on a LDS mission for a little bit and then came back, started going to college in x-ray tech, right? Because that's what my parents wanted me to do. And I'll be honest with you, Randy, like that time in my life, we're coming up on, 2012, 13, where I was the oldest of my siblings. Growing up, I was a people pleaser, and I always was. I think for most of my life, I lived my life for what other people wanted from
Mhm.
me. I lived because I never wanted to disappoint people, right? And so that's why I went to school to be an X-ray tech, and why I did X, Y, or Z. But I was, you know, not living my life. And then in March of 2013, and Randy, this is, apologize if I get a little emotional because this is where my life changed.
Mhm.
It was March 13th. That's St. Patrick's Day, right?
Mhm.
Um, I was going to college in Utah. Came up to Idaho to see my parents. I was with my little brother and my grandma, and we were driving back to Utah Sunday night about 7 o'clock, and we were in a bad car accident. So, in 3 days, right? It'll be the 5-year anniversary, or 2013. So the 12-year anniversary, and I lost my little brother and my grandma in that
Goodness.
car accident. Um, sorry, it's 3 days
No,
away.
that's
Kind of
amazing. Yeah.
hit
Yeah.
me
I'm
the
sorry to hear
feelers a
that.
little
That's
bit.
terrible.
Um, from that accident, I realized that I had been given a second chance. And my little brother, Clancy, he and I were only 22 months apart. I was 21, he was 20, right? His birthday's in February, mine's in April. And so that's kind of where. And Clancy didn't give two craps about what anybody thought. Right? Like, if he had a goal, a dream, like, he unapologetically would go after it. And, I took a lot of his attributes as my own after this accident, after he passed away, because I'm like, you know what? He lived a full life. At his funeral,
Mhm.
there were, standing room only, like, for a 20-year-old kid to have that kind of funeral, right? That's amazing. In a small
Mhm.
town, right? Like, our graduation class was only 40 people, right? So he made an impact, and it made an impact on me and who I became going forward. And so from that day forward, I decided I'm going to live my life for me unapologetically. And that's when I didn't go back a single day to medical school. I went and signed up for the School of Business, got into entrepreneurship, got into real estate. I ended up graduating from Utah State University with a bachelor's in finance and a minor in entrepreneurship and real estate. So,
That's
um,
amazing.
and then I really got started in the real estate game in 2015, 2016, bought my first duplex in 16, and, pretty much scaled from duplex, fourplex to smaller multifamily to now kind of getting in the mid-sized game, so I can
Wow.
expand
That's
anywhere
awesome.
you'd like me to expand.
Yeah, no, first of all, thank you for sharing and being vulnerable. People go through challenges, and goodness, hopefully nobody has to go through what you went through, but it sounds like you've been able to take that challenging situation and really kind of integrate it into your life, and it's become a part of who you are and driven you to do a lot more than what many at your age have done. So thank you for sharing that. That's an amazing story, and I'm sorry you and your family and the community had to go through that. But yeah, it sounds like it drives you.
It does.
At this point, you started in real estate. You ended up doing duplex quad. What have you amassed since that point? Like, what's the portfolio look like today?
Yeah. So the portfolio right now, I actually only have a 54 unit that we run and operate that's up in Missoula, Montana.
Okay.
We bought that in September 30th of 24. Last year, I sold all of my smaller stuff in Utah, and then so I moved actually from Utah up here to Eastern Idaho to
Okay.
be closer to the partner that we're doing Cowboy Capital with.
Okay.
But I do have my fund of funds as well that, I started in like 22. We're partnered with Rise 48 on a deal in Dallas, um, partnered on a 368-unit deal up in Ohio that we raised some money for, and then two different custom home builds in northern Utah as well. Um,
Fantastic. Okay.
so sold all my
Okay.
small stuff to just focus on the mid to bigger sized stuff.
Perfect. So yeah, you're kind of going down a path where you're active in the multifamily, small to medium size, and then you're also doing fund to fund. So how do you decide whether you are going to be actively involved in pursuing new deals or like just bringing capital to other people's deals? Is there a determining factor there, or is it just you're going to do both of these strategies? Curious.
Yeah. I'm pivoting just a little bit with the fund because we want as much of our own equity to go to our own active deals as possible,
Okay.
right? And so I'll kind of backstory a little bit for you. The reason why I even started the fund. So I had bought a 24-unit deal in 2021, March of 21. It was a 1951 build,
Okay.
so it's old.
Sure.
And we ended up renovating the entire project. It was a massive renovation project, right? Because we were taking it from a 24 to a 32 unit. That was the only way that we can make the numbers work, right? We bought it for $2 million and we gutted the place pretty much down to the studs, had to do a lot of asbestos and lead-based paint remediation, but like brand new kitchens, bathrooms, the whole 9 yards, right? That was my first project of that, extent of construction.
Sure.
And I thought, so like the partners that I brought on, I thought that we had all had a little bit more experience with this kind of deal, but it was far hairier than any
Uh-huh.
of us could ever expect. And so it took us, we were over budget, over timeline on, and I'm okay talking about, I think every sponsor should be transparent about, kind of the tough times, right?
Sure.
This was 100% a tough time because we bought it March of 2021 and sold it September of 24. We bought it for 2 million and we sold it for 6.25. But we put about 3 million into it. It was a little over 100,000 a unit that we put into it, right? And what happened is that we ran into a bunch of construction trouble, right? This was one of my greatest learnings, is that because like we had 2 or 3 construction companies, generals come and give us bids that were all higher than our original budget. But then there was a general that came out of Idaho that she was kind of not a one-man team, but she had a much smaller team, and her bid was significantly lower. And so we're like, hey, let's go with her. Trying to keep on cost, and it bid us, right? She
Yeah.
took us for a ride and we lost a bunch of money. And it actually happened twice that we had 2 different generals take us for a ride. And so it was rough on the construction world. And so, as you know, like I have experience in construction, I only live 45 minutes from this property. And so for about 2 years, I was showing up 3 to 5 days a week, swinging the hammer myself, right? Because I had family money in this deal.
Sure.
Right? I had
Sure.
raised money from my cousin, my father-in-law, and my uncle, and I, showed up multiple times a day for 2 years. And that's just kind of how I work, right? It's just like that's my commitment. I tried moving things around with partners and whatnot to try and change things up. At the end of the day, we just had to keep showing up to get the job done, right?
Sure.
It's been
Sure.
easy to just let it go and let it default, but at the end of the day, we were able to, when we sold it, we were able to give our investors 100% return of capital with a small return on capital. And so like, I feel like that was a win because we still were able to give them 100% of principal back. And they got a ton of cost segregation, right, for those 3 years.
Sure. Sure.
70 cents, 80 cents on the dollar for 3 consecutive years. Like that, there was some benefits, but it was also like a huge learning for me and how I've been able to move forward and do deals going forward. And so the reason why I started the fund through this is I wasn't making money anywhere else, right? I
Sure.
had quit my full-time job to do this deal and to make sure that it was moving forward. And I had to find a way to generate revenue. And so what a better way to do that than to raise money for somebody else's deal that has like Rise 48, they've got 2 billion assets under management. They have the track record, um, and everything going for them. And so for me, I was like, hey, that's going to make a lot of sense to deploy capital with guys where I'm protecting my downside because they have so much experience, right?
Yep.
And
Yep.
for the most
Absolutely.
part, our experience has been good. So now, coming to today, most of our equity that we're going to have, we're going to put into our own common equity deals. But if they're, and so our fund is going to be more of a kind of a cash flow agnostic fund where, if we have RV parks or storage or, we'll look at different asset classes because we can run those through our fund. So other opportunities that's outside of kind of like our main bread and butter of multifamily. So
Yeah. Yeah. And I think it makes a lot of sense. I see, some operators, maybe they do 1 or 2 deals a year, and their investors quite often are looking for more deal flow than just 1 or 2 a year. And I think, leveraging that fund to fund model where they continue or consider partnering with other operators, it can continue to give them deal flow
yeah,
to satisfy their investor appetite for more deals, make a few dollars, of course, and then it kind of decreases their dependence on finding that next deal. And I think if you look at kind of the motivation and the drivers behind these, like a lot of times you have operators that are out there just doing deals because they need that acquisition fee.
right.
Whereas if they can really sit on the sideline and wait for just the very best deal that's going to match exactly what they want to do,
Yeah,
sure, they can supplement not only their own income, but deal flow for their investors by partnering with other people, but let them focus on what they do best. And I think it can make a lot of sense. Something I've considered with my business as well. I'm the other direction where I'm, almost exclusively fund to fund manager, but I'm about to get into the active space as well. So I'm going to do the other route where I'll consistently do fund to fund, but then occasionally have opportunities that I'm working on personally. So yeah, I think that's an interesting model. I'm curious. Let's kind of shift a little bit if we can
for
and
sure.
talk a little bit about kind of the current market and what type of deals you guys are looking for. I know you guys are focused primarily in the Western US. So are you going to continue focusing in those areas, and what type of assets are you looking for?
Yeah, yeah, we are focused on these Western states because essentially, like from where we're located right now, and call it Rexburg, Idaho, we can drive 4 hours to our Montana deal. We can drive 4 hours to Boise, and like 4 hours south is, like Provo, Salt Lake area.
Sure.
My partner has a big deal up in St. George. That's a bit further, but most of like where we're going to buy is within a 4 hour drive, which we really like. And I know that our investors, because we have a really strong local investor base, they want to be able to touch the asset too. And they like that we can get there very quickly if we need to take care of problems. I think there's been a lot of deals where there hasn't been any boots on the ground. And so when crap hits the fan and you're just counting on like a foreman or a property manager who doesn't have the same incentive that you have, like things are going to slip through the cracks, right? And so that's why we like to really operate here. And from what we've heard from other operators and other investors, like there's not a lot of guys that are just focused on the Western front. And so that's where we feel we have a competitive advantage because we're able to just focus here and find the best deals, right? There's a deal that we're bidding on right now where the broker reached out to us and said, hey, out of all the sponsors and brokers that are in this area, like we think you guys are the best fit for this deal, right? It's a rinse and repeat of our deal that we did up in Montana.
Okay. Okay. Yeah.
And
Fantastic.
the other thing really quick too that I think is very important is like where we have such a strong local resource base up in Montana, it would have cost us probably 20,000 a unit to do like all of our renovations. That's brand new cabinets, countertops, paint, flooring, accessories, what have you. But we brought our relationships from Salt Lake. We brought painting and flooring and cabinets.
Mm,
And so our cost is closer to 12,000 a unit just because we have local resources that will drive to our properties, right? Which is also cool because they say we get the
sure.
deal In Boise, then it's just like, hey, it's a rinse and repeat. It's just like, come up, bid it. You're 4 hours away. Let's go.
Yeah, no, that's interesting. I like those kind of tertiary markets as well. Interesting. Like there's a lot within 4 hours of where you guys are.
Mm-hmm.
And a lot of those areas where you're not going to see some of the bigger guys coming into those markets at all. They have no desire to drive 4 hours when they can really hone in on a much smaller one. So now you had mentioned earlier too that you guys are focused kind of in that sub 100 space as well, which has been really interesting for me to start looking at as well. A lot of the bigger shops, they want to be in 100 plus because then you have dedicated property management. But there seems to be this niche in the middle there where it can make a lot of sense. Can you talk to the audience why you guys like focus on that specific area or that specific size?
Yeah, for sure. I think a lot of it is just because that's what we've really built a track record of being really, really good at. Most, like, I haven't done a deal 100 plus outside of the fund of funds. And so like I've really been able to hone in and focus on these, 40, 50. And I used to be a property manager actually back in 2018-19 on an 80 unit, right? So I know really well how to asset manage, construction manage, property manage these smaller deals. The benefit that we have too is a lot of the deals that we're looking at right now and that we're working on we're buying them from kind of do-it-yourself owners, right?
Sure.
Like the deal up in Montana, we bought it from a guy who had built it in 98, right? And he hadn't really increased his rents. And we were able to build a lot of rapport with him through the broker. And when we bought that deal, we did like a $380 increase across the board, and 60% of the tenants renewed at that rate, which is crazy. And we can go into numbers another day, but like that property, like we've increased value by $2 to $3 million just in 5-6 months that we've owned it. And so like a lot of the deals that we're doing right now are owners that have owned it for 10, 20 years and are, ready for a good sponsor to come in and, buy them out. And it's been interesting too. This last deal that we did or that we're working on right now, I've never done this before, but I guess it's starting to become more prevalent, but like a buyer interview. We were on the phone with the broker and the seller for over an hour. He was just asking us questions, getting to know us, right?
Interesting.
And
Okay.
they're a 20 plus owner too. So I think right now in this day and age, with COVID, it was a lot of non-face-to-face type stuff, over Zoom, everything. But I think that what's coming back is more of that personal touch, and sellers are even wanting more of that personal touch, which is really cool for us because that's what we love to do. And I think, to go towards more of your question, right? Like, yes, with 40, 50 units, it's more challenging to, with property management and construction management. But where we're so good at that, all you need is 250 units to get, a full-time PM. And that's our plan. And that's the other reason we have a competitive advantage is because we'll buy a bunch of small properties in the same MSA and have economies of scale between multiple properties. Right. And so it's like with Boise, we went up there and toured 6 deals, and they were all between the age of 92 to 2024. So we're looking at new construction as well. And those guys are motivated to sell because same reason, right? They started in 2021 building and they're coming up on the bridge debt and they need to sell because a cash in refi is just far too expensive still. So that's why we're like, let's keep that 10-year high so that we can get a decrease, because a lot of these new construction deals, like, we're able to get under replacement cost. Even in, like, I know Idaho, or not Idaho, but like Texas, I see David Lilly. I can't remember what company he's with, but he put a post on LinkedIn where they're like buying deals 20-30% below and buying them from foreclosure. That's not really happening. There's not really foreclosures happening in Montana, Idaho, Utah, but there are deals coming due and there are sponsors that are ready to get out. And so that's where, and what's cool about the deals up in Boise was a 48, a 46, a 52, right? Like, you just bundle a couple of those and you have your economies of scale that you need there. And now you've got a presence there. And when you have a bundle too, it's easier to sell to like maybe more of an
Exactly.
institutional group. It's like, here's a 3-property portfolio of 150 units with meat on the bone. Now you can go do what you want with it and sell them individually and maybe get a better price, or, maybe they have 100 units or 200 unit properties where now they can combine everything and sell them to a bigger group. So that's kind of our strategy. Like we're still going to play in the 100, 200 plus range as we grow, but right now the bread and butter is 30 to 100 unit complexes where we can buy multiple.
Love it. Yeah. Well, very good, Joe. I think, you guys are doing a lot of good things. You've got a very specific niche up there, which you guys are continuing to refine those skills and build your track record. I think it could be a really, really great opportunity for investors to partner with folks like you, because you're going to bring something to the table that a lot of the big guys just aren't. So for investors that are interested in connecting with you and your team, how can they find you, Joe?
Yeah. So I'm on all the socials, LinkedIn, Instagram, Facebook. I'd say shoot me an email, joe@upcfund.com or invest@cowboycapital.com. And then, those are the main ones.
Yeah, awesome. Well, very good. Well, let's jump into our final 5 so we can offer some additional education to our investors or our listeners. Can you share an educational resource that you suggest for folks to continue on their passive investing education journey?
Yeah. I don't have like a very specific like book or specific thing. What I'll say is like podcasts, I think, are becoming the new. Like I love podcasts, right? Because you can come on and like listen to my story, and anything that you can do to cut down the learning curve, right? In your own journey, like you can go on ChatGPT and be like, give me the top 10 podcasts that help me make sure I don't work with a sponsor that's done capital calls or something.
Sure.
Right?
Sure. Yeah.
And there, a bunch of podcasts will, pop up. So I would say, like, if you're really wanting to learn how to get into this or to invest more, like education, listening to podcasts is a great way to do it. And I think the other thing too, that's an educational resource, is like I'm learning things from myself just by talking with you, Randy. So sometimes getting out there and teaching what you're reteaching yourself stuff,
I love it.
So,
yeah.
but listen to Randy's podcast. He's got good stuff on there. Good lessons.
There you go. And now, how about books and podcasts that you either are reading or listening to yourself? Any favorites that come to mind?
Yeah, I'll mention a book and a podcast. So the one podcast that you and I talked about before is one of my mentors, Ryan Miller. He runs a community called Fundraise Capital, where he's taught us how to, raise capital from retail investors all the way to sovereign wealth funds and family offices and royalty. It's crazy. But he has a podcast called Making Billions, where he interviews guys who have all raised over $100 million. They're in that 9-figure club, and it's amazing. Some of these, podcasts and guests that he has on there. And then a book that I'm reading recently is by Bill Ham. It's called Real Estate Raw. So I actually paid like for an hour of his time, like a month ago, because I was working on a very creative deal, and he's good at creative deals. And he taught me, like in his book, Real Estate Raw, it's like he shows like a conveyor belt. And because like this one deal, I wanted it to be like my generational wealth, my 10-year, 20-year asset. But like no investors right now wanted like a 10, 20-year deal. They want 3 to 5 year stuff. He's like, you can't think of any one deal as your generational wealth. He's like, what you need to have is a conveyor belt of deals. And he's like, you need to use that conveyor belt as your generational wealth. So each year or however long, like you buy a deal, you put it on the conveyor belt. Next year, you buy a deal, you put on the conveyor belt. You buy a deal, you put on a conveyor belt. And Randy, I would dare say that you've seen that with your fund of funds. Like, and I've seen it as fund of funds. It's like you invest in a deal, you put it on the belt, and like pretty soon, like those 3 to 5 years start hitting. And so now you start getting exits and exits and exits. right? And so like you can't count on just one deal to be like, okay, this is going to provide me all my cash flow, or this is going to be my generational wealth. Like it's got to be that conveyor belt that's your generational wealth. And that really changed my mindset because so many people are just always trying to get the home runs. But if you put a base hit, double base hit, right? Like once they
Yeah.
start hitting multiple times in a year, home run, home run, home run, right?
I love it. Yeah. I kind of teach my investors the same thing in their passive investments. Like, let's invest, 50 or 100 grand a year for the next 5 years. And next thing you know, this thing starts kicking off 50 or 100 grand a year. And most people, if you can give them 100 grand a year in income, that's tax advantaged. Like,
Right.
that's a game changer. So yeah, I love that idea, both from an operator standpoint and a passive investor. So great, great, great advice. Thank you.
Yeah.
All right. What's a good due diligence question that you think investors should be asking that maybe they don't always ask?
Yeah. I think right now, one of the biggest risks in a deal is, from my perspective, is construction. And, because like if you're going to go and implement a business plan, like it's going to involve renovations at some capacity. And so I think what I've seen, like if the team or the sponsor or even your boots on ground don't have as much construction experience, like that's where things can really start to go sideways. And in a high interest rate environment like this, that's just like one more thing that could really hurt the deal depending on where you invest. So like I would ask the team what their experience is with construction or who they have on their team that will be running solely the construction management aspect of the deal, right? Because I think a lot of sponsors will, so many people just focus on raising capital, finding deals, but who's actually going to be running that business plan, the asset management? I think construction management is a huge aspect of that, where the deal could be amazing or it could die because of that. So
Great advice. Yeah, it's like all of these value add plans are strongly dependent on the people that are actually managing the construction piece. So really, really good advice. I think you've got debt and you've got the asset management or the construction management, which are really two of the biggest risks. So
yeah,
great perspective coming from a construction guy as well. Like you see this probably better than anybody, where you see value add plans that just go south because they're not being managed correctly. So yeah, great advice. Okay. All right. So a couple of fun ones here to wrap it up. Let's see here. Do you have a recent bucket list item that you've checked off your list or one you're hoping to in the near future?
I'll give you a quick one of both. So I have never been on a vacation just by myself with buddies.
Okay. Yeah.
So I went to Cabo about a month ago with two of my buddies, and we were able to mastermind because they're both in business. They both do real estate, and so we were able to. I was there for 3-4 days, and just mastermind, which was amazing. And a future bucket list is Bora Bora. Really want
Oh,
to
very
go to
nice.
Bora for a week. So
Yeah, I love it.
it's a
I love
reward.
travel bucket list items. Yeah.
Yeah, it's a reward for a big goal hit. So
All right. And final question. If you had to invest 100 grand today and you couldn't put it in one of your own deals, where would you put it?
yeah, let's see. It's a good question. I would probably split it up a little bit. Probably put 50K. We invested, into these short-term custom home builds, and I really like those deals. So I'd probably throw 50K with them for a shorter term, quicker return. But then I really like, there's a group out of New York. I can't remember his name right now. Dang it. But those guys do 20-year deals. Their investors stay in for 20 years. And so like I would throw PK in with them and I would just forget it, you know.
I love
So
it.
at
Yeah.
least,
Good diversification.
yep.
Perfect. Well, Joe, this has been a lot of fun. It's a different perspective to hear one coming from the construction mindset and your background. So that was really helpful. And then also in this small to medium sized sub 100 space, it's something I'm really interested in. I think you've brought a lot of value here today, Joe. So thanks so much for being on the show.
Yeah. Thank you, Randy. I really enjoyed it and excited to talk to anybody who wants to learn more.
Outstanding. Awesome. And to our audience, as always, we encourage you to continue that education journey on passive investing. But more importantly than that, we urge you to make the decision to invest in your first or into your next passive investment. Both Joe and I are convinced that once you do, you'll just wish that you had started that much sooner. So be sure to join us again next Thursday for another great episode. And don't forget to like and subscribe wherever you're listening. Thanks so much for joining us today.
Well, there you have it, ladies and gentlemen. Another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.